Hi everyone, this is Emily and I'm a digital transformation consultant at Hyperbots. I'm very happy to have Shaun on the call with me, who is the SOC Compliance Manager at Norfolk Southern Company. So it's really great having you, Shaun.
Glad to be here. Thanks for having me.
Of course. The topic we'd be discussing today is optimizing financial control with an optimal chart of accounts. And we'll explore, how exactly an optimal chart of account can serve as a foundation for better financial control within a company. So to begin with, Sean, how does an optimal chart of account help, in controlling expenses within a company?
So I'd say optimal COA. It allows for granular tracking of expenses. It categorizes them into meaningful heads. For example, travel, office supplies, marketing, utilities, and it helps to identify certain spending patterns. It monitors deviations from the budget. So those are just a few examples.
So, Sean, can you explain how a well-structured chart of accounts can, ensure accuracy in general ledger updates for revenues, costs, expenses, assets, and liabilities?
Sure. So a well-structured chart of account will have distinct heads for each type of account. So you want to have separate accounts for different revenue streams, for example, product sales, service income, and different cost categories like direct materials and overheads. So that will ensure that the financial transactions are recorded accurately and consistently and adhere to all the accounting standards.
Got it. And how does the chart of account contribute to effective cash management?
So it can support cash management by categorizing cash flows into the three main categories, which are operating, investing, and financing activities. And this helps to understand the sources and uses of cash, which is crucial for cash flow forecasting.
So, sort of curiosity, in what ways can an optimal chart of account help minimize variances between actuals and provisions?
So it helps to minimize variances by providing accurate, timely, and detailed financial data, which will support better budgeting and forecasting, and it allows for detailed variance analysis by breaking down revenues and costs into specific categories.
Also, Sean, could you provide examples of how an optimal chart of accounts enhances forecasting and projection?
Yeah, so a well structured COA supports forecasting by maintaining detailed historical data in a very structured format. So that's vital for trend analysis. For example, a SaaS company might use a chart of account to track different revenue streams, such as subscription fees, professional services, and consulting. And by analyzing historical trends in customer acquisition and retention rates, the company can project future revenues more accurately. And it also allows for different like what if scenarios. And so if there's changes in sales volumes or cost increase, make forecasts based on those assumptions.
Understood. So, Sean, how exactly does a well organized chart of account align with, key performance indicators in a company?
So a well organized chart of account can be designed to align to a company's KPIs, which allow for consistent tracking and reporting of performance metrics. For instance, if a company's KPIs include gross margin, operation margin, and net profit, the chart of accounts should have specific accounts that allow for accurate calculations of these metrics. And if we align the chart of accounts with the KPIs, companies can ensure the financial data is easily accessible and relevant for decision making.
So, just out of curiosity, Sean, what are, some of the common mistakes that companies make when structuring their chart of accounts and how exactly can they avoid it?
Sure. So some common mistakes would include creating an overly complex chart of account that may be redundant or duplicative. Also, using vague or inconsistent naming conventions or failing to align the chart of accounts with business objectives. Some ways to avoid it, companies should do a regular review of their chart of account to eliminate redundancies, ensure clarity in account naming, and align with certain industry standards and best practices. Leverage technology such as AI to scan for duplicates and redundant accounts.
So, Sean, now that you just spoke of AI, I'd want to, wind things up. So, how exactly can technology, particularly AI, enhance the management of the chart of accounts for better financial control?
Yeah, AI is a powerful tool. So one of the things it can do is automate data entry. It can detect anomalies. It can ensure accuracy in financial data. So what they can do is automatically classify transactions into the correct account, so that it reduces manual errors. It improves consistency. It can also identify patterns and trends that might not be immediately apparent, different expense patterns that may indicate fraud, for example. AI can help regularly scan that, streamline the chart of account structure, and then just ensure that the company's financial objectives are achieved.
Thank you so much, Sean, for talking to us about optimizing financial control, with an optimal chart of accounts. It was really great having you, and the discussion was truly insightful. So, thank you so much.
Absolutely. Thank you for having me.